Right now, at kitchen tables in Brisbane, Newcastle, Adelaide, and the outer suburbs of Perth, Australian retirees are having a quiet conversation that could cost them tens or even hundreds of thousands of dollars. Not because they have done anything wrong, not because they're trying to dodge the system, but because nobody, not their accountant, not Centrelink, not Services Australia, ever sat them down and said, before you book that one-way ticket, here's what the ATO does the moment you walk out of the country. I spent almost 30 years inside the Australian Taxation Office, the last stretch of it working specifically in international tax and residency, the rules that apply when long-term Australian residents pack up and move overseas. Since I retired, I've been running free Saturday morning sessions at community centres and legal aid offices for older Australians who are thinking about exactly that. And I'll tell you this honestly, I see the same shock in people's faces every single week. They've done everything right. They've worked hard. They've saved carefully. They've lived here for 30 or 40 years. They're on the age pension. They've got super, maybe a share portfolio, a paid-off home. They have a perfectly good reason to want to spend their later years closer to family. A son in Manchester, grandchildren in Auckland, or simply a gentler cost of living in Thailand or the Philippines. And they have absolutely no idea that 4 separate ATO rules are waiting for them at the departure gate. Today, I'm going to walk you through all 4. By the end of this video, you'll understand which ones affect your situation and what you need to do about them before, not after. Your plans are locked in. Before I start, let me be clear. I'm not a financial planner, a solicitor, or a registered advisor. This is general information based on my professional experience. For your specific situation, please speak with a registered tax agent who specializes in cross-border residency and a financial planner who understands international retirement structures. The rules vary significantly depending on where you're going. The first rule sounds almost administrative, almost like a technicality. It isn't. When you leave Australia with the genuine intention of living overseas permanently or indefinitely, the ATO applies something called the domicile test and the 183-day test. For most retirees settling in another country, the answer comes back quickly. You're now a foreign resident for Australian tax purposes, effective from around your date of departure. Here's where the numbers hit hard. As an Australian tax resident, you pay no income tax on your first $18,200 of taxable income each year. That's the tax-free threshold. As a foreign resident, that threshold disappears entirely. You're taxed from $1 drauzod at a flat 30% on income up to $135,000. For someone drawing $50,000 a year from Australian sources, that single change means roughly $9,500 more in tax every year. Not a rounding error, not a minor adjustment, a meaningful recurring annual hit to income that most retirees never saw coming. The Medicare levy stops, which is a small saving, but the loss of that tax-free threshold swamps it. Now, here's what makes this more complicated. If you're over 60 and drawing from an account-based pension inside superannuation, that income is tax-free in Australia. That's one of the genuinely wonderful features of the Australian super system, the tax protection built into retirement phase withdrawals. But that protection is an Australian rule, and it only applies to you as an Australian tax resident. The moment you settle in another country, that country's tax rules apply to your income. Depending on where you're going and what the tax treaty between that country and Australia says, your super pension income could become fully taxable in your destination country at full local income tax rates with local allowances applying. The UK is a good example. Australia and the UK have a comprehensive tax treaty. Under that treaty, the UK has the right to tax pension income in the hands of UK tax residents, even if the underlying fund is an Australian super fund. So a super pension that was completely tax-free while you lived in Brisbane can become ordinary UK taxable income the moment you're resident in Manchester. The fund doesn't change. The rules around the income do. New Zealand has a treaty. Most European countries have treaties. Thailand has a treaty. But the pension treatment under that treaty is structured differently from the UK position. The Philippines has a treaty, but generally doesn't tax Australian-sourced pensions for resident retirees in the same way. Every destination country needs its own analysis. The point is that my super is tax-free is only half a sentence, and the second half changes completely depending on where you live. The second rule is the one that causes the most alarm in my Saturday sessions, and it's the one that catches people who've been quietly, diligently building up an investment portfolio for 20 or 30 years. Under Section 104-160 of the Income Tax Assessment Act, when an Australian tax resident becomes a foreign resident, they are deemed to have disposed of every CGT asset they own that isn't what the ATO calls taxable Australian property, now at market value on the day they depart. This is CGT Event I1. And in plain English, it means this. The ATO treats the moment you board the plane as though you sold every share, every managed fund, every investment outside of Australian land on that exact day. The capital gain is calculated. The tax is owing. The fact that you didn't actually sell anything, that the shares are still sitting in your chess account untouched, is irrelevant. The deemed disposal triggers the tax as if you had sold. Now, there is an election available. You can choose to disregard the deemed disposal, which means the CGT event doesn't happen at departure. But if you make that election, those assets continue to be treated as taxable Australian property, meaning when you eventually do sell them, Australian CGT applies to the entire gain from original acquisition to eventual sale, even if you've been living overseas for a decade. You don't get out of the tax. You just choose when you pay it. And the right answer, whether to take the deemed disposal now or defer it, depends on factors that are specific to your situation. How much the assets have grown, whether you held them for more than 12 months and can access the 50% CGT discount as a resident, what the tax treatment of capital gains is in your destination country, and when you're likely to actually sell. For someone with a long-held share portfolio in CBA, Telstra, or BHP, this is a decision worth tens of thousands of dollars in either direction. It needs to be modelled carefully by a specialist before the tickets are booked, not after. One more piece on property, because it matters. The family home, for most Australian retirees the single largest asset, is generally exempt from CGT while it's your main residence. But that protection changes the moment you become a foreign resident. Foreign residents can't access the 50% CGT discount on investment properties. And from July 1st, 2020, foreign residents generally can't access the main residence exemption when they eventually sell, even for a home they lived in for decades. A family home sold from overseas by someone who has been a foreign resident for several years can attract a CGT bill that simply wouldn't exist if the same property were sold while the owner remained an Australian resident. That's not a small difference. For properties in Sydney or Brisbane or Perth with substantial unrealised gains, that could be a six-figure consequence. The third rule, and I want you to stop whatever else you're doing and pay attention here, is the one that if you get it wrong, doesn't just cost you money. It can destroy your fund entirely. If you are a trustee of a self-managed superannuation fund, the consequences of getting this wrong are not inconvenient. They are catastrophic. For an SMSF to remain a complying fund, which means being taxed at the concessional 15% rate on earnings inside the fund, it must satisfy three separate residency conditions at all times. The fund must have been established in Australia or hold an Australian-situated asset. The active member test must be satisfied. And the central management and control of the fund must ordinarily be in Australia. That third condition is the one that gets retirees. Central management and control means the high-level strategic decision-making of the fund. The investment strategy, major allocation decisions, fund administration direction. If the trustees, the people responsible for those decisions, are physically outside Australia for more than 2 years, the ATO determines that central management and control is no longer ordinarily in Australia. At that point, the fund loses its complying status. And here's what that means in dollar terms. A non-complying SMSF is taxed at 45% on its assessable income for the year it loses compliance. The accumulated balance of the fund on the day non-compliance begins is also included in that assessment. For a fund with $800,000 in it, the tax consequence in a single year can approach $300,000. A retirement plan built over decades, gone in less than 2 years of living overseas simply because nobody told you that your super fund had its own residency requirement. There are solutions, but they all have to be put in place before you leave. A genuine temporary absence of up to 2 years is allowed, provided it's documented properly. You can appoint a corporate trustee with Australian resident directors who can maintain central management and control while you're overseas. You can roll the SMSF into a public retail super fund before departure, which removes the residency issue entirely. Each of these has complexity and cost. None of them can be put in place once you've already been overseas for 18 months and realised the problem. The clock starts the day you leave, not the day you realise there was a clock. The fourth rule sits at the intersection of the ATO and Centrelink, and it's the one that surprises people most, because it doesn't fit neatly into either system. The age pension can be paid overseas, but the way it's paid, and how much of it you receive, changes significantly once you've been gone for a while. After 6 weeks overseas, the pension supplement drops to its basic rate. The energy supplement stops entirely. After 26 weeks outside Australia, the pension is reassessed using a formula based on what's called your Australian working life residence, the number of years between age 16 and age pension age that you are an Australian resident. If you have 35 years or more of Australian working life residence, you continue to receive the full age pension overseas. If you have fewer than 35 years, the pension is proportionally reduced. That reduction can be significant, in some cases, several $1,000s a year. Now, here's the rule almost nobody knows. If you've been receiving the age pension for less than 2 years at the time you leave, the pension cannot be made portable. Full stop. It cannot go with you. You'd need to return to Australia, and you cannot receive it overseas during that 2-year window. For a retiree who has just recently qualified for the pension and is planning to move overseas in the next few months, this means the pension simply stops the day they depart. The years of residency don't matter. The contributions don't matter. The 2-year portability waiting period is a hard rule. And there's one more layer. For those going to countries with a tax treaty, the UK in particular, the age pension income may be taxable in the destination country. In the UK, the Australian age pension is treated as taxable income in the hands of a UK resident, subject to the UK personal allowance. That doesn't mean it gets taxed heavily. The personal allowance is reasonably generous, but it does mean the tax-free status you had as an Australian resident doesn't automatically travel with you. When I explain these 4 rules, the reaction in the room is almost always the same. 2 people look at each other. The older one says, "Well, we'll just go for a year first, see how it feels. Keep things flexible." And that can work, but only if it's structured properly. Here's the thing. If you leave Australia with the clear intention of living overseas permanently, if you arrive in the destination country, set up a rental, obtain a residency visa, transfer your banking, you have very likely already triggered the tax residency change from your departure date. The intention matters as much as the duration. And going back 2 years later creates a separate residency event, not an undoing of the first one. 2 changes, 2 CGT calculations, 2 years of foreign resident tax treatment. It doesn't simplify, it compounds. The other mistake runs in the opposite direction. Some retirees spend 6 or 9 months a year overseas, Thailand, Spain, Portugal, on what they describe as an extended holiday. They tell themselves they're still Australian residents because the trip is temporary. The ATO doesn't use your description of the trip. It looks at your physical presence, your habitual abode, your family and economic ties, and the intentions you held before and during the absence. Someone spending 9 months a year in Thailand on an annually renewed retirement visa with a Thai address as their primary home has almost certainly become a Thai resident for tax purposes, regardless of what they call it. So here are 3 concrete things worth doing this month if you're seriously considering retiring overseas, or if you have a parent or family member who is. First, engage a registered tax agent who specializes specifically in cross-border residency, not your suburban accountant, a specialist. Both the Chartered Accountants Australia and New Zealand Directory and the Tax Institute Directory allow you to search for international tax specialists, ask them for a written planning report that models your position under both Australian rules and the rules of your destination country, with specific reference to the relevant tax treaty. Expect to pay between $1,000 and $3,000 for that report. The protection it gives you is worth many multiples of that cost. Second, if you have an SMSF, do not leave Australia for more than 3 months without first speaking with a registered SMSF auditor about your fund's residency position. Your protective options, a corporate trustee, a rollover, a documented temporary absence plan, all need to be in place before you depart. Once you've been overseas for 18 months and the clock is running, your options narrow significantly. Third, book a free appointment with Services Australia's Financial Information Service to understand exactly what the age pension portability rules mean for your specific working life residence years. They won't advise you on the ATO side, but they'll tell you in plain terms what happens to your pension the moment you depart. The number to call is 13230. Ask for a Financial Information Service appointment, either by phone or in person. The people I work with didn't make mistakes. They worked hard. They saved carefully. They contributed to the tax system for 30 or 40 years. They have entirely reasonable, entirely human reasons for wanting to spend their later years closer to family, or in a climate that's gentler on aging bodies, or in a country where their savings go further. The problem isn't the decision. The problem is the gap. Nobody told them. Not their accountant, not Centrelink, not Services Australia. not the bank that manages their super, not the financial planner they saw 5 years ago. The Australian Taxation Office has 4 separate rules that activate the moment a long-term resident boards a plane to retire overseas. 2 of them can trigger 6-figure tax consequences. 1 of them can destroy a super fund. All of them can fundamentally change the economics of a decision that felt straightforward. The households most likely to be affected are exactly the households least likely to have been told about any of this. If this video gave you something useful, share it with someone who needs it. A parent, a friend, a colleague who's been talking about moving back to the UK or spending their retirement years in Southeast Asia. These are exactly the conversations that need to happen before the tickets are booked, not after. This content is general information only and does not constitute financial, legal, or tax advice. Please consult a registered tax agent specializing in international residency and a licensed financial planner before making any decisions about retiring overseas.